friends, in this video we are going to discuss about some of the important questions from the area of business finance which were asked for Nta Ugc net exam. Okay, so while dealing with this particular module business finance, these are some of the important areas from which you can expect questions for every exam. Okay, the first one is operating cycle, then leasing, it's about lease financing. Then theories of capital structure, a number of theories and 4 main theories were there. So, it can be related to the assumptions or some match the following questions are normally asked from this particular area. And coming to cost of capital, from this area every time they are asking question either to calculate cost of calculation regards to cost of capital or some general questions which you can identify from this particular area. So, today we are going to discuss about some of the Nta Ugc net exam from these important portions. Okay, so coming to our first question which were asked in December 2019, which of the following is the correct sequence of various stages of operating cycle of a manufacturing company? So, this is a question about sequencing the steps which is involved in an operating cycle. Okay, and we have different options and we have different sequences here. Okay, so before going to deal with this question, you should know what do you mean by an operating cycle. See, operating cycle is also known as working capital cycle, or it is also known as cash cycle. This is showing the time duration or the time that can be in days or in months, the time which is required for converting cash to cash equivalents. Okay, so see, it is a time duration for the conversion of cash into cash equivalents like raw material, work in progress, finished goods, sundry debtors, and thereafter back into cash. That means with your cash you are purchasing raw material from the suppliers and you are using it for the production. Then before getting finished goods, it will be a work in progress, then it will reach a finished good, a complete goods, then we will sell it to our customers. If it is on credit, we will have sundry debtors, then we will receive the money back from these debtors. Okay, so this is the way how the cycle is actually going on. Okay, so coming to its steps, the first one is you are using your cash for purchasing the material, that is conversion of cash into raw material. Okay, so here you are purchasing your raw materials using your cash, that is the first step. Then conversion of raw material into work in progress. Then what is happening, again this raw material is converting to work in progress. Okay, after that it will convert to finished goods, work in progress, then it will become finished goods. Then again after that we will sell this finished goods to customers. If it is on credit, we will have a person like debtors. Okay, so the conversion of finished goods into debtors through sales. So, this debtors is actually created in case of sales, and conversion of receivables into cash. And when we are receiving cash from these particular debtors, it will be again converted to cash. Okay, so this is actually going like a cycle. See, with cash you purchase the raw materials and again now it become work in progress, then the finished goods you sold it to the debtors, now the receivables were there, and from them you are getting the cash back, you will receive again the cash. So, cash is again converted to different forms and finally again we are getting the cash back. So, this is a way how this operating cycle is going. So, when we are discussing about its calculation, or that when we are discussing about the days which is required for converting or completing this one cycle, okay, how much days is actually required for completing this one cycle, this is actually depicted in our operating cycle. So, see, coming back to our question, the first step is raw material conversion period. Yes, that is the first step. When we discussed about operating cycle, we know that the first step is purchasing raw material. So, the first step is raw material conversion period. Yes, RMCP. So, with that option we have 3 options, option A, B and D. Both these are starting with the raw material conversion period. And what about the second step after raw material conversion period? We are using it on production and it will become work in progress. So, the second step is work in progress conversion period. So, the second one will be work in progress conversion period. Yes, here we have 2 options. Now, you can eliminate option D, as in second option it is given as finished goods conversion period. Okay, now you have 2 options, option A and option B. And what about the third step after work in progress? Next one is finished goods conversion period. Now, yes, see, the third step is finished goods conversion period and the final steps is receivables conversion period. Okay. So this is the correct sequence in relating to operating cycle. So the correct answer for this question is option A. Now moving to another question, which is actually in June 2019, a sale and leaseback arrangement is more suitable for lessee having liquidity crisis, surplus fund, high profit, no loss. So this is actually a question from the area of lease financing. Okay, so there are different types of lease financing, and before going to study about the sale and leaseback, you should know what do you mean by leasing and all. Okay, so leasing is actually an agreement. Okay, it is an agreement between two persons. One is the owner of that particular asset and the other person is the user. Okay, so it is a general contract between the owner and the user of asset over a specified period of time. Maybe that lease is for a particular period of time. The asset is purchased by the lessor, that is the leasing company, or the owner of the asset is actually known as the leasing company, and thereafter leased to the user. The person who uses this particular asset is known as lessee or lessee company. Okay, and see this lessee means the user, lessor means the owner. So this lessee will pay the lease rentals to the lessor. Okay, so which pays a specified rent at a periodical intervals, that is known as lease rentals. Okay, and this is actually considered as an alternative to purchase of an asset out of owned or borrowed funds. So this is actually giving an option, either you need to purchase a particular asset or you need to take a asset on lease. Okay, either you can go for buying or you can take it for a lease. So this is actually giving such an alternative to choose from different options. So coming to the major types of lease, these are the different types of lease, and see the first four are very important types of leases. The first one, operating lease; second one, finance lease; sale and lease back, that's where in our question; leverage lease, that is very important; sale aid lease; then close ended and open ended lease. So we already discussed about each of these types of lease in our LMS. So coming to the one which is asked for your exam is sale and lease back. Okay, so we can just have a look on them. See, what do you mean by this sale and lease back? Here the owner of the asset sells the asset to the party, that means the buyer, who in turn leases back the same asset to the owner in consideration of lease rental. This is a situation, you are selling and you are leasing it back. This is a situation, sale and lease back. So here the owner of the asset, he will sell his asset to another party. Okay, the owner of asset will sell his asset to another party and then he will take it on a lease. The owner sell his asset to another party and from that party he will take the asset on lease, take back the asset on lease. That is a situation. Okay, owner of the asset sells the asset to a party who in turn leases back the same asset to the owner in consideration of a lease rental. Okay, so asset is not physically exchanged, but it all happen in records only, because there is no need to make a physical change as the owner is going, or the owner becomes the lessee now. So it is no need to make a physical transfer, there is only need for changing in the records. Okay, so this avoids liquidity problem of lessee. See, if this is or why this particular owner is selling his asset, maybe he needs more fund. Okay, if he sells his particular asset, he will get a huge amount from the person who from the buyer. Okay, so from the buyer this owner is getting a huge amount, and when he leases it back he need to pay a small amount as lease rental. Okay, so this will actually improve the liquidity position of the old owner, that means the lessee, because now he became the lessee. Okay, see, lessee can satisfy himself completely regarding the quality of assets, and after the possession of asset convert the sale into lease agreement. So here as the lessee was the owner, he was the previous owner of that particular asset, he can ensure about the quality of asset. Okay, that is one of the important thing. And in this type of leasing, here the seller assumes the role of lessee. Seller means he was the previous owner who sold his asset to another party. So the seller of the asset become lessee and the buyer of the asset become lessor. Okay, so the seller gets agreed selling price. So what about seller? The seller is getting a huge amount, the price which he paid for the particular asset. And what about buyer? Buyer will become the lessor. Okay, now he will get lease rentals. Lessor will get the lease rentals, and the seller of the asset will get the selling price of that particular asset. See, in order to get it more clarity about this, see, this is a situation which is happening in sale and lease back. Okay, here the seller means the previous owner of the asset. He sells his property to another person. That person is known as buyer. Okay, now this buyer, so earlier it was with seller. After he sold his property to this person, he became the lessor, or now he is the owner. Okay, so he became the landlord or owner of the asset. And what about seller? Now from this landlord, he leases back his property. Okay, he sold his asset to another person. Now the person who bought that particular asset is known as the landlord or the lessor, and from him the tenant or the old owner or the lessee leases it back, and now this old seller become tenant, that means lessee, and buyer will become the landlord, that is lessor. Okay. Now coming back to this question, a sale and leaseback arrangement is more suitable for lessee. Lessee means the user. Okay, lessee means the user. Who is lessee? Here this seller become the tenant, that means seller become lessee. Okay, so see, this lessee having liquidity crisis, surplus fund, high profit, no loss. If it is a situation that this lessee have a surplus fund, whether there is a need to sell his assets back to a particular person? No. This is actually, the reason is liquidity crisis. As the person is suffering from some liquidity problem, he sold his asset. Okay, and he will receive a huge amount, and thereby he leasing it back, he needs to pay only a small amount of lease rentals. So this is, or a sale and lease back is actually happening, this or which is more suitable to lessee who suffers from liquidity crisis. So it will improve the liquidity position of lessee or the previous owner of the asset. So the correct answer for this question is option A. Okay, another question on June 2019. This is an assertion reasoning question from the area of capital structure theories. Assertion is given as, according to net income NI approach, capital structure decision is relevant in the valuation of firm, and the reason a firm can change its total value and its overall cost of capital by change in the degree of leverage in its capital structure. So this is actually explaining about the net income approach of capital structure theories, and we have the different options connected with it. So coming to the theories of capital structure, in order to achieve the goal identifying an optimum debt equity mix, it is necessary for the finance manager to be well versed with the basic theories underlying the capital structure of corporate enterprise. So we know that in order to have a better debt equity mix, it is very important that there are lots of things which the financial manager needs to be considered for fixing a capital structure or fixing an optimum capital structure. And when we are dealing with this theories or approach, each of these theories or the different theories in collected with capital structure is actually showing the relationship between the capital structure, cost of capital and value of the firm. So how this cost of capital or value of the firm is going affected with the change in the capital structure, that is actually discussed in each of these approaches. Okay, and these are the four important approaches under capital structure method. Okay, net income approach, net operating income approach, the traditional approach and Modigliani-Miller approach. So all these approaches are very important, and it is very important that you should study assumptions related to each and every approaches. In questions in our previous question, you can see that they are asking about assumptions. They will give the question that please identify which is not an assumption of MM approach or traditional approach or net income approach. So you should study the assumptions related to each and every approaches. Okay, so coming to this net income approach, this was proposed by David Durant, and this particular approach says that the capital structure decision or the change that you are making in your capital structure definitely affect the value of the firm, or if you are making any changes in the capital structure, it will affect the firm's value. Okay, so a change in capital structure causes a corresponding change in the overall cost of capital as well as the total value of the firm. So not only on the change of value, it will also shows an effect on the change in the cost of capital. So according to this net income approach, whenever there is a change in capital structure, it will affect cost of capital of the firm and one more thing, what is that? The value of the firm. So see, a higher debt content in the capital structure, that means in your capital structure, if you are using more debt funds, okay, what will happen? Your overall cost of capital will decline, or your overall cost of capital will reduce, and thereby the value of the firm will increase. Okay, so if you are using more debt content, or if you are using more debt proportion, if you are just considering the capital structure when comparing to equity, if more debt is actually there, what will happen? The overall cost of capital is declining, and what about the firm, value of the firm, it will increase. As cost is declining, the value of the firm increases. Okay, so that is actually discussed under this particular theory, and here there are certain assumptions. So these assumptions are very important regards to each and every approaches. Okay, so the first assumption is that the cost of debt is less than cost of equity. So the first assumption in this approach is that the cost of debt is always lower while comparing to the cost of equity. Okay, so cost of debt is given as KD and cost of equity KE. Okay. And see, there are no tax, that is a second assumption. Tax is not actually considered under this approach. Then the risk perception of investors is not changed by use of debt. So there is actually no change is actually happening to the risk perception of the investors, as even though they are using more debt or less debt, that is not actually making any change in the perception of investors regards to risk. And KD and KE remains constant with the changes in the leverage. That means even if the changes is actually happening in the debt content, the overall cost of debt and cost of equity remains constant. Okay, see, in this particular diagram you can see that cost of debt and cost of equity, and see, if the cost of debt is increasing, what is actually happening to the overall cost of capital? KO means it is the overall cost of capital, and you can see that the overall cost of capital is declining. Okay, if you are using more proportion of debt, this x-axis is showing about the debt proportion. So if you are using more and more debt, what happens to your cost of capital? Your overall cost of capital declines. Okay, so as the proportion of debt KD in the capital structure increases, the weighted average cost of capital reduces. So KO means it's the overall cost of capital, or it is the weighted average cost of capital. Okay, and KO will decrease, the overall cost will decrease as the debt proportion in the capital structure increases. That is actually we discussed under this particular diagram. Again, coming back to our question, according to net income approach, capital structure decision is relevant in the valuation of the firm. Yes, the net income approach says that if you are changing or if you are making any changes in your capital structure, that will affect the value of the firm. So here the decision regards to capital structure is very important. Okay, so the changes actually affect the value of the firm. So the decision regards to capital structure is relevant. Okay, so the first statement is correct. So according to net income approach, capital structure decision relevant in the valuation of the firm, it will affect the value of the firm. So that is correct. Okay, and what about reason? A firm can change its total value and its overall cost of capital by change in the degree of the leverage in its capital structure. So the reason is saying that a firm can change its total value. A firm can change its total value and overall cost of capital by a change in the degree of leverage. That means in your capital structure, if you are changing the degree of leverage means if you are improving your debt or increasing your debt, what will happen? You can change your cost of capital and the value. Yes, isn't it? By increasing more debt, or if you are employing more debt on the capital structure, it will surely affect your cost of capital and your value of the firm. So this is actually discussed as a reason. Okay, so as assertion is about net income approach, it's saying that the valuation or the changes in the capital structure or capital structure decision is relevant. This reason is actually supporting the assertion which is above. Okay, so you can say that both these are correct, and what about whether this is R is supporting A? Sure, this is actually saying that capital structure decision is relevant, and the reason is actually saying about why it is relevant, why we are saying that the decision regards to capital structure is relevant. This is because if you are making any change, that will surely affect the value of the firm and that will affect the cost of capital of the firm. So you can say that both A and R are correct, and R is the correct explanation of A. So the correct answer is option A. And NTA December 2018 question, which of the following sources of finance has an implicit cost of capital? Another important area, cost of capital. See, this is a question about which we have different sources of finance is actually given in your option, and you have to find which has an implicit cost of capital. So what do you mean by this cost of capital and all? Cost of capital means it is the minimum rate of return expected by the investors from their investment. Okay. So minimum rate of return a firm must earn on its investment so that the market value of the company's equity share does not fall. So it is very important that they should attain up to this minimum rate of return. If it is not able to reach up to that level, what will happen? The value of the share will fall. Okay. So the minimum rate of return expected by its investors, that is another definition you can quote for it, and this is actually showing a direct relation with the risk involved in the business. That means if the risk is more, the cost of capital will also increase. Okay. That means if a person is taking more risk, he need more return. Okay. So in such a way that the cost of capital is more to that particular investor. As we know that more risk is actually in hands of equity holders, as equity shareholders, as they are the owners of the company. So the cost of equity is always more comparing to other cost of securities. So higher risk, higher cost of capital. Okay. And this term implicit cost. Implicit cost is a rate of return which can be earned by investing the funds in alternative funds. Like you have two alternatives, either you can invest your cash in your bank or you can invest in a particular security. You have two options, either this or this. Okay. So if you are going to deposit on bank, you are not going to get any dividend from the securities because you are not able to invest there. And if you are going to invest on a particular security, you will miss the interest that you are getting from the bank. Okay, so that is the situation. This is actually called as opportunity cost. So it is an opportunity cost, that is a cost of opportunity foregone in order to take a particular project. In order to take one, you need to sacrifice the other. Okay, that is the situation of opportunity cost. And coming to this cost of retained earnings, see, retained, what do you mean by this retained earnings? Retained earnings is actually a part of profit, so which were reinvested in business. Okay, retained earnings refers to the portion of earnings left with the company after distribution of dividend to shareholders. So we are keeping a part of profit, and the remaining part is actually we are distributed as the dividend. Okay, so we are plowing back some part of profit. Okay, so this retention of earning is from the profit of the business for a financial year. Okay, so coming to the cost of, there is actually cost for each and every sources. Okay, like cost for preference share, equity share, debt, and all cost for each and every sources is there. Coming to the cost of retained earnings, it may be defined as the opportunity cost of dividend foregone by the shareholders. Okay, that means this retained earnings is actually a part of profit. Okay, profit is normally distributed to shareholders. Okay, but now they retained a part of profit. Okay, in this situation, it is actually sacrifice made by the shareholders. Okay, in such a situation, this is considered as an opportunity cost of dividend foregone by the shareholders, because they decided that, or they decided to receive only a small portion of profits as dividend. Okay, so this situation is actually considered as an opportunity cost of dividend foregone by the shareholder. So in case of this retained earnings, there is a cost of opportunity cost. And coming to its calculation, how you can calculate cost of retained earnings? Cost of retained earnings is equal to cost of equity multiplied by 1 minus T multiplied by 1 minus B. Here T means it is the tax rate and B is about the cost of purchasing new securities, or it can be the brokerage cost. So this is a way how you can calculate cost of retained earnings. And when you are considering the different cost, most cheapest cost is actually considered as cost of retained earnings, and which is the highest cost of capital comparing to different sources. Cost of capital is more for equity shares as they are bearing more risk. Okay. Again, coming back to a question, which of the following sources of finance has an implicit cost of capital? The first one, equity share capital. preference share capital, debentures, retained earnings. So, in case of equity share capital, we know there is not such an implicit cost is involved, its cost is more comparing to other different types of sources of fund. Anyway, which one is the implicit cost? That means the opportunity cost, it is actually the retained earnings, because it is the opportunity cost which foregone by the shareholders as dividend. Okay. So, the correct answer for this question is option D. So, in this video, we have discussed some of the important questions and important areas which were asked for NTA UGC NET exam, and see, these areas are very important and you should practice different questions from these area. You need to attend more test papers regards to these area. So, I hope this video will help you for your preparation of NTA UGC NET and JRF. Happy learning. Thank you.